So now I just want to discuss briefly why I think this downside correction has the potential to get a little bit violent. Hello, everyone in the land of Arcadia economics. My name is Dave Kranzler from investmentresearchdynamics.com, and this is another episode of my bi-weekly podcast. Before we get started, I need to let you know that this episode is sponsored by Silver Viper. You can find Silver Viper at VIPRF on the OTC bulletin board and VIPR.V on the TSX Venture. And of course, you can find it at its website. The company just completed a $3.3 million unit financing. I believe it was one stock, one share, and one warrant. That's in Canadian dollars. The proceeds will be used to further advance the Law of Virginia project. I believe they have a extensive drill program planned for this summer, so it should have lots of news flow. And just by way of interest, the unit deal came at 10 cents per share Canadian. It's now trading up 50% from there. The deal came about a month ago, closed, and it's trading around 15 cents. That's just the stock. So I own the stock. I like the project, and in my opinion, I look at this as a very cheap call option with no expiration. It's got about call it roughly $20-25 million US market cap, and this is potentially a multi-$100 million project. I will say that, the story will probably require some patience for it to develop. I wanted to talk today a little bit about what's going on in the precious metals sector. I don't think I have to tell anyone that we're in a bit of a correction, a price pullback here. It's something I actually was looking for to happen late January, early February, and it took longer to develop and unfold than I expected. I do think that we're in a pullback that will set up the next move higher. It'll be what I think will be a very large move higher, and I'll explain why. And then at the end, hopefully, I can offer up a nice, tasty morsel for dessert in the form of a stock idea. So let's get started. Got a chart of GLD up here. I use it as a proxy for gold, for the price of gold. And one thing people need to keep in mind, and this applies to the entire sector, except for maybe the junior microcap, early stage project development companies, which have not participated in the rally that I'm going to demonstrate has occurred since September. Unfortunately, my portfolio is overweighted in those. But the good news is, if this cycle that we're in is similar to previous cycles, we have a move that doesn't include the junior microcaps, and then the next move includes the junior microcaps times 3 to 5 times, or even more in some cases if you pick the right stocks. So gold has had, it ran up 24% between late September and late April, and that's a pretty big move. You can see here, I'm also making the argument that the sector became a little bit frothy, for sure technically overbought, and these charts all look similar. The numbers are just a little bit different, but gold here is up 24% in the space of, about 6 months. That's a decent return. It certainly outperformed the stock market, and it got stretched over the 200-day moving average. And now we have a little bit of a double top formation, and it's in a pullback. And again, as I'll explain, we could be coming to the end of the pullback, but it's an ending that will experience some violent downside, as we've seen the last couple Fridays and yesterday and today. So one thing that I think is good to watch, this could be just a 50-day moving average pullback. I made these charts yesterday. I'm recording this on Wednesday midday. And gold GLD is right now, or it was earlier this morning, just below the 50-day moving average. It could hold that, and if it does, that'd be great, because this will be a shallow pullback. There's an outside chance it could go down to the 200-day moving average, but again, it'll be painful but brief, and will pop right back up. And I'll explain why I think that might occur also in a minute. So that's gold. One thing I wanted to point out here, and again, these charts are all quite similar, but you have declining volume here accompanying this downside here. And that could indicate that the sell energy is starting to run out of steam. We'll see. The next chart is silver, which I use SLV to represent. I do that just because my Fidelity platform makes prettier charts than my futures platform does. But SLV in the same time period as gold roughly is up 46%. So that's a hell of a return. It way outperformed the NASDAQ, the Dow, the S&P. But again, it became overbought. You can see that here with the RSI and the MACD, the double top here, and a little bit of violence in the downside here. And yesterday, silver was below the 50-day moving average. I think today it was up a little bit. I haven't checked the screens in the last couple hours. But silver is now starting to get quite oversold. And that's a good sign. Again, it doesn't mean that we're not going to have, another brief leg down. We could go down to the 200-day moving average. Right now, it doesn't feel like it will. And again, you've got declining volume here. The next chart is GDX. And GDX is up 63% over the same time period. Now, quite frankly, if people are complaining about the precious metal sector and the way it's performed, I'd have to say you're malcontent. I mean, a 63% return in 6 months, and what more can you ask for? I suppose, you could wish you were invested in the tech stocks when they went idiotically higher in a very short period of time, but now they are in the process of correcting, and they're in a bear market, and it's going to get a lot uglier for them over time. It may not feel like it in this recent bear rally, but it will. Trust me on that. Again, you've got the double top formation here. It became overbought. Got the RSI and the MACD here. It rolled over. Again, declining volume. And as with gold and silver, I mean, you could have a 50-day moving average correction. You could have a 100-day moving average correction, or you could have a 200-day moving average correction. This is possible, I guess. I don't know. I mean, even if it goes down to the 200-day moving average, if you had bought a small portfolio of mid-cap and large-cap mining stocks, you still have a hell of a return between the end of September and now. So now I just want to discuss briefly why I think this downside correction has the potential to get a little bit violent. Again, we've already seen some of that violence in the big cliff dive sell-offs over the last couple Fridays. Fridays is the traditional day when the Comex banks decide to monkey hammer the price of gold and silver. That's because by the time the Comex opens, just pretty much London, some of Europe is still open, but the rest of the world, particularly the physical buying gold world, has gone to cocktail hour and stopped working for the weekend. So it makes it easier for the manipulation to occur on the Comex. And just as an aside, it's not just manipulation. I mean, the hedge funds and the CTA funds bring it on themselves. They get over their skis on their long position, and I'll show that in a second here. And the banks bombard key technical levels, where the sell stops, where the stop losses are set, and the CTAs and the hedge funds just automatically disgorge their long positions, and that's what creates the fishing line, as Jim Sinclair would call them, or the cliff dive chart formations that you see. Again, if you go look at an intraday chart of Comex gold or silver the last 2 Fridays, and you'll see exactly what I'm talking about. And it sucks to go through it, but it's just a reality of investing in this sector. So this chart, and this is from cotpricecharts.com. I want to give proper credit. I did put some of my own edits in here, but these are fantastic charts. And this shows the gold contract, the Commitment of Traders report, which comes out every Friday. And it shows it for the Comex gold contract, the gross long positions for the banks and the hedge funds is on the left y-axis, and the total open interest on the right y-axis. Now, just a little bit of a clarification here. This chart is segregated into large spec, which is hedge funds, CTAs, and other investment funds, as well as what they call other reportables. And it's like kind of non-registered money management funds, like family offices, very wealthy individuals, that type of thing. We don't need to worry about the small specs. That's retail. And then the commercial, which is, again, this is producers, hedgers, blah, blah, blah. And then what they call swap dealers, which are the bullion banks. And we can kind of ignore that also. The primary players here are the hedge funds and the CTAs and the banks. So what happens here is the open interest goes through cycles where it builds up and it increases quickly, and it's primarily a function of the hedge funds piling into long positions and getting into very large net long positions. And you can see that here, here, and here. And at the same time, the banks short, they just print up Comex contracts and short into the hedge funds buying it. We can get into why that's an artificial market. It doesn't represent reality another time, but this is just what happens. This cycle has been repeated for as long as I've been watching the COT intently on a daily and weekly basis, going back to probably 2003. It's probably when I really started. In 2002 is when I started trading gold and silver futures. And you can see here the banks have the offset of a short position to the hedge fund long position. And then what happens is you go through a cycle where the banks bombard the Comex price, and it forces the hedge funds to mechanically, because these are algo programs that are causing this to ebb and flow. And it causes them to disgorge. And while they're gorging themselves on contract longs, the price rises. And when they disgorge, the price falls. Now, again, this is kind of within an overall longer term picture where the price of gold and silver, despite the games being played on a day-to-day or quarterly to quarterly basis, whatever. I mean, let's face it, the price of gold and silver since 2001 have outperformed all three major stock indices. So, and just you got to focus on the big picture as well as the small picture. And right now, this is the small picture, and this is the reality that we're facing. And so, what I think is going to happen here is you're going to probably see some more violent down days. And what happens is these funds disgorge themselves of these contracts. They got their black box algos set up, and the banks use the big sell-offs to cover their short position. And that's why you see these patterns that keep repeating. And here we are again, same pattern. So no telling how much longer this could run. It's just as a warning, it could get painful. I wouldn't necessarily be putting money to work right now in the sector, because you're not going to time the bottom, and the next move up you'll be very happy if you have cash that you can jump in as the move develops and is confirmed. Again, the rule of thumb is you want to try and catch the middle 2/3 of every move. So at some point soon, this little game that they play on the Comex is going to run its course. And again, you can look at the charts and decide where you think it's going to end. I mean, no one knows for sure. I mean, who knows? Something could happen and it may be over tomorrow without ever having a big bleed off like we've seen in the past. However, once it does run off, there's going to be some glaring, obvious fundamentals that'll be the basis for fueling the next move higher, away from an oversold condition, blah, blah, blah. So the obvious one, and it is getting attention now, but probably not as much attention as it should, is the U.S. debt load. And it's getting attention because we're having the every so often game of kabuki theater the Republicans and Democrats play over raising the debt ceiling. It could be suspended for a while before they agree on raising it to some idiotically higher level. The bottom line is the U.S. government spends trillions more every year than it takes in revenues. And at some point, that's going to undermine the dollar, and it's going to really push gold a lot higher. Now, I wanted to share this chart because this is now where the annualized cost of serving I think it's up to 32 trillion or 31 trillion in Treasury debt. And you get at a point, and I don't remember which economist it was, a classic economist, who said when you get to the point where you're paying, you're spending a large majority of your revenues into the government on servicing its debt, that's when it's lights out. And again, it doesn't mean lights out happens automatically and right away. It'll take some time, but after all, it's taken, let's call it 71, so 52 years from 1971 to now to get to this point. But again, it's kind of a slowly and then boom, suddenly. And this is going to get worse. And at some point, the Fed's going to have to crank up the printing presses to buy the flood of new Treasury issuance that's coming, where we're going to see interest rates go a lot higher. Second thing that's happening is, and some of you probably are experiencing this more or know people who are experiencing this more than others, is that more people are, the households have a record level of debt, and more people are falling behind on their credit card and car debt. And as a matter of fact, you might not be reading about it, but mortgage delinquency rates are also starting to move up. And again, that's one of those things where it happens slowly and then all of a sudden, suddenly, and we'll go from, if you've got, say, 0.9% of the mortgages are 30 days behind or 30 to 60 days behind on their payments, all of a sudden you're going to see 3 or 4%. And that's about, the overall mortgage market was about 4 or 5% delinquent or in default, I believe, in 2008, 2009, even though it was all the 125 LTV and adjustable rates that got, that got demolished, and had a much higher rate of delinquency and default. It was really, you'd be surprised at just, how little of delinquency and default rate it takes to unstabilize the banking system. So as you can see, consumer debt hit a record, we're at 17 trillion, delinquencies rising, and jumped ahead of the game there. So a lot of this is a product of it's credit card debt hitting new highs. We're in an economic contraction. I don't care what the talking heads and the idiots and the officials say, Fed and government officials. We are in an economic contraction, and all the major sectors of the economy are in a contraction, and they have contracting economic activity. And it's starting to affect households, and households are getting squeezed, and they're borrowing more money to make their monthly required payments, the non-discretionary payments, and some of them can't even make it. And that's why we're starting to see delinquencies. And again, I mean, this is going to blow a hole in the balance sheet of banks and credit card companies. I don't care if they're moving up in the stock market now. That's a short-term thing. And at some point, this, as well as the federal debt situation, is going to cause the Fed to have to start printing money unless they want the whole system to collapse. And that's always a possibility too. I don't think that'll happen. I think they will start printing. I think we got one more cycle of that before the dollar completely collapses. But we'll see. You never know with these guys. They've already done a lot of head scratching things over the last couple decades. So, and that's, assuming we're getting at or close to an end in the precious metals correction pullback, technical pullback. I do think it's setting up the platform for a big launch, and I don't know when that'll happen. It might happen next month. It might happen midsummer, and it might not happen until the end of the summer, early fall. That sort of seems seasonally when we get good moves in the precious metal sector, but we'll see. And what I wanted to do was just illustrate a stock that I play actively in. I cover it in my mining stock journal, and it looks like it actually may be ready to rock and roll now. And that's everyone knows Hecla Mining, and you can see it had a fantastic run up here. I did well trading call options this whole time period on it, and it didn't even really have a double top. And some people might have said, "Oh, there's head and shoulders forming here." Well, no. I mean, it's started pulling back and corrected more sharply than the rest of the sector, and it's now down all the way down to its 200-day moving average. And you can see that the last leg here of the sell-off, there's one of those fishing line cliff dives I talked about earlier, and it's been accompanied by declining volume. You can see the RSI and the MACD got very overbought, and now they're down in very oversold territory. And it could go below the 200-day moving average, and I wouldn't freak out if it does. If we get some more paper bombs dropped on the Comex and that push the price of gold and silver down temporarily, this thing very well could, briefly go through the 200-day moving average, but it'll snap back up. And this is one that, I mean, I have my core positions that I hold long term. I mean, I'm either accumulating over time, the less liquid junior microcap stocks, and the only time I sell them is if I change my mind on the story and why I invested in it. I think Hecla is fundamentally a great investment, and I also think that technically it's ready to go. And I actually started buying some, I can't remember which expiration it is. It's end of May expiration, near money call options on it. And I could be wrong on it. I'm about break even now from when I started accumulating them a few days ago. And if I'm wrong, I'm wrong. They're under, they're 10 cents. And if I'm wrong, I'll wait a little bit and retry the trade, because I think at some point you're going to see Hecla launch back up well over $6 a share, where it was not too long ago. And so this is what I'm kind of actively trading right now, and I'm being patient and waiting for the sector to come to me, and that's when I'll put some cash to work in more of the juniors. So I hope everyone found this interesting. The next issue of my mining stock journal is coming out tomorrow. I've got some good ideas in there. I've got some fresh updates on my core portfolio companies, and you can find more information about it at Mining Stock Journal. I'm sorry, not Mining Stock Journal, investmentresearchdynamics.com. And until 2 weeks from now, hope everyone takes the opportunity to get outside and enjoy the spring weather.